Hello, and welcome to the show Rock Chalk Investors. We are here with Sarah and Mubarak, representatives of the Walt Disney Company. Today, we will be interviewing them about their company's finances. First, tell us a little bit about the history of Walt Disney.
The Walt Disney Company was started in 1923 by brothers Walt and Roy Elias. It began as a small cartoon studio in LA, and after the success of the cartoon Mickey Mouse, Disney produced their first full-length movie, Snow White, which was the highest-grossing movie.
In 1940, Disney began producing television programs and continues to do so today. In 1955, the Walt Disney Company opened its first theme park in Athens, California. Today, there are 11 theme parks around the globe, with one scheduled to open in Shanghai later in 2016.
Now we will go to Mubarak, who will tell us about Walt Disney's balance sheet.
Thank you, Devin. The company increased their total current assets by a sum of $4 billion, from $84 billion to $88 billion in the past year. They had a total liability account of $16 billion and $334 million, and an equity account of $48 billion and $655 million. One of Disney's largest assets is their theme parks. There are currently parks in Florida, California, Hawaii, Paris, Shanghai, Tokyo, and Hong Kong. They make up $25.2 million of the company's total current assets. Some of Disney's liabilities include borrowings, deferred income taxes, commitments, and contingencies, and other long-term liabilities. One part of Disney's equity is stock. There are currently 4.6 billion authorized shares, 2.9 of which are issued as common stock. 100 million shares are preferred, and 2.3 billion shares are treasury stocks.
So now that Mubarak has talked about the balance sheet, Sarah, can you tell us what your income statement looks like?
Yeah, so our service and product revenue make up our total revenue, which is about $52.4 billion, and that was recorded in October of 2015. Our total costs and expenses come from cost of services, products, selling, as well as depreciation and amortization. The total of these expenses is $39.2 billion.
Excellent. Have you seen any noticeable changes in the company's profits?
Yeah, so our gross profit increased over $2 billion from 2014 to 2015. Our earnings per share have also increased, and they show no signs of slowing down.
Lastly, I would like to touch on the ratios of your company. Tell us a little bit about your working capital.
In 2015, we had $424 million in working capital, which is the company's current assets minus its current liabilities.
What benefits do you see from that number?
So $424 million is a relatively high number, which means we have a lot of cash on hand, which allows us to have the opportunity to buy out other companies.
Excellent. What about the current ratio?
Our current ratio is 1.026, which puts us in good standing. Typically, a ratio above 1 and below 3 is best. We saw a minor decrease in that ratio from 2014 to 2015, which does not have much significance.
So with the products that you distribute, what is your inventory turnover ratio?
In 2015, our inventory turnover ratio was 18.038, which is higher than the previous year. This increase is very good in terms of generating sales.
What about the company's return on equity?
We are dedicated to using our shareholders' money effectively, and in 2015, we had a 19.78% return on equity.
Moving on to the debit to equity ratio, would you consider the company to be low or high risk?
The company is relatively low risk with a 36.69% in 2015.
Finally, what can you tell us about the book value per common share?
The book value per common share determines the level of safety associated with each share in Disney after all debits have been paid. It is the amount of money the holder of a common share would get if Disney were to liquidate. The growth from 2014 to 2015 shows that shares in Disney are becoming more valuable and therefore a very good investment. In 2015, each share was at $20.73.
Now we are going to send it to Mubarak for the accounting policies and notes to financial statements. I'm sure you're all so excited.
The Walt Disney Company, together with subsidiaries through which businesses are conducted, is a diversified worldwide entertainment company with operations in the following segments: media networks, parks and resorts, studio entertainment, consumer and interactive products. The company tested its goodwill and other intangible assets and found that long-lived assets and recorded non-cash impairments charges of $10 million in 2015, $46 million in 2014, and $5 million in 2013, respectively. Trade names and characters and visual and written properties are licensed by the company, the Disney Store, through disneystore.com and through marvelstore.com, are all used to distribute the different products that the company sells. The company operates in North America, Europe, and Japan.
Now Mubarak is going to discuss Disney's future plans for growth.
Disney is committed to continuing growing their company. Disney currently owns ESPN, which makes up 30% of their valuation. They also recently acquired programming rights to premium channels and plan to raise the price of their ESPN subscription fee. This will increase their fee revenue and increase the number of subscriptions. Disney also plans to improve their theme parks. They are working on developing Avatar Land and plan to bring back Star Wars and Frozen-themed park attractions. This will increase their theme park attendance and revenue, and which also will cause a greater demand for Disney products or Disney hotels within the park.